Thank you, Rach, and thanks, Olivia. Appreciate it. Thank you for everyone coming out. We haven't done many of these in-person sessions for a lot of years. This is one of the haunts we used to be at, and it's, as you're, good luck staying awake. It's beautiful and warm and climate controlled for the art, which we get to have a browse around afterwards as well. Personally, thank you for Arvid and Flick for, Arvid from flying down to Sydney, from Sydney today to Melbourne to drive up to Horsham. So very grateful for that. And I think everyone agree we look like twins nearly, in definitely the way we think about markets and investing. Please ask questions as we go along. I definitely playing second fiddle to Arvid. I want you to get more time seeing Arvid chat than myself. You can all chat with me whatever you like, but let's just make a few smart decisions before the end of the financial year. Now, the general advice disclaimer, which we put up, please take a photo in your mind of that, but essentially means that it's general advice only. Same goes for Arvid. He'll have his own delicious general advice disclaimer as well. So, given it's the end of the financial year, it's always generally a superannuation discussion. So why is superannuation important? Well, 15% going into super when you make contributions as opposed to your marginal tax rates. When you actually get to retirement, then it gets pretty exciting that, and there's a lot of noise around superannuation and the 3 mil, the caps and the extra tax that's applying for some people that in their individual accounts. If you've got over 3 mil, then there may be some extra taxes, and there's this unrealised capital gains tax, which really stinks a lot. It's pretty unprecedented to tax something on an unrealised gain. But for the average person that has up to $2 million from the 1st of July, you get to age 60, you retire, husband and wife have $2 million each in super that is completely tax-free. Within the fund, there is no 15%, and the money you take out, completely tax-free. That is 4 mil per household. It's exceedingly generous. So that's why the fuss, why we should be trying to get money into superannuation. But let's go through some of the contributions. And I also want to note that, June 30, and I still remember driving up to nil on June 30 when Lewis, my eldest son, was a baby, to get a check to run it back down to get into the bank. The actual money needs to be physically at the superannuation fund. So, being on the way via, obviously check's no longer a thing, as we all know. It's got to be in the fund well prior to June 30. So do your tax planning May, start of June to get money in nice and early. So this gives you a bit of an idea of, again, why 15% when you make a concessional contribution to reduce your taxable income, you pay 15%. If you earn over $250,000, then it's Division 293 tax, you get to pay an extra 15%. So some of the farming years have been that of late, but for most people it's 15% compared to 32, 39 and 47. Any money under 45,000, we do not get that excited about having to try to save 3% in terms of tax, and where we're locking it away in superannuation where you don't get to touch it. We'd prefer to see debt reduction or use it within your business. So how do you make contributions? There's a lot of self-employed people in the room. So self-employed people generally go for personal contributions where you're making regular repayments or a lump sum. If you make that lump sum, at the end of the year, you need to use what is called an intent to claim form. So this is you saying to your superannuation fund, hey guys, I want to claim this as a concessional contribution and I'll pay the 15% instead of my marginal tax rate. For those people in the room that are employed, and there's people like myself, I'm self-employed, but I'm also an employee of my company, and I can still do salary sacrifice. So my employer can put in the extra salary sacrifice on top of my 11.5% each year. So I often go for this option because it's simple, You ask your payroll officer to do it once and there's no other forms. There is no intent to claim form because the super fund already knows that it's a concessional contribution. Now, these are relatively new. I'm not quite sure, can't remember the timelines exactly, but you're able to utilise, if you've got less than $500,000 in superannuation in your super balance, any concessional contributions that you didn't use for the prior 5 years. So the 1920 is, if you don't use that this year, that is gone. So if you've had a capital gains event, so you've sold something, had a good result, you can go back and use concessional contributions where you pay the 15 cents on the dollar tax instead of your marginal tax rate. You can go back and use all those up as long as your super fund is under 500,000 June 30 the year prior. So that's been really handy, particularly for farmers when they've sold their business. Quite often, their super funds are not that high because farms have a habit of drawing in capital and being reinvested, which makes sense. Reinvesting into businesses is something that I, very keen on and encouraging of. So that's the catch-up concessionals. Then there is the non-concessional contributions. This is where you're putting in your after-tax money that you've already paid your tax on. So this is where you put money that's, say $100,000 is earning 4%, $4,000 per year. That $4,000 goes on top of your other income and pushing you up into higher tax brackets. We do this particularly around, putting larger lump sums in when people are retiring, when they're getting close to access. I wouldn't be suggesting a 40-year-old put in large non-concessional contributions because it locks it away unless there is some real strong tax advantage in doing so. Concessional contribution, we get tax advantage, that's a different story. It's about balance. So it's after tax. So again, there are limits on how much you can put in, and that is $120,000 per year. And once you get up to have a total super balance for this year is 1.9 mil, you can no longer put any extra non-concessional contributions in. From the 1st of July, the total super balance or the transfer balance cap, how much you can go to pension tax-free. Once you're over that limit, you can no longer put non-concessional contributions in. You can still put in concessional to help keep your tax down. So that's the yearly limit, 120, and these are both the 30 grand and the 120 is indexed, and I think it's indexed in 10,000 increments for the non-concessional and $2,500 for the concessional. But here, so with the concessionals, you've got the carry forward, the stuff you didn't use in the years prior. With non-concessional, you can bring future years forward to make it really confusing. So you can put in one financial year, either anywhere between 120 or anywhere between 0 and 360 grand. So why would we do that? Preparing your funds for retirement, getting into an eventual tax-free environment. Interest rates have gone up. It wasn't that long ago that our term deposits were getting 0.4. $1 million in a term deposit would bring in $4,000 per year. That wasn't that long ago. Obviously, interest rates have gone up, it affects your marginal tax rate, and we also use it for what we call recontribution strategy, where we're taking care of what we deem to be essentially a death tax, but I'll cover that off in a second. But the timing matters. So we're in June 2025, we can put in $120,000 now, and at the start of July, we can put in $360,000. So we can this is per person, not per couple. So you can get it, up to $960,000 for a couple. Now, obviously, we would not put that amount of money away unless it's part of a sort of retirement plan and they're getting close. So you can sort of just think a little bit. It's clearly an overthinking chart, isn't it? So there's a few caps. I won't bore you with this, but once you get over certain limits in terms of how much money you've got in super, they do cap on how much you can put in. That is an amazing problem to have, that if you've got two people that have got in excess of $1.76 million. These are good problems. We're happy to run into them. Now, the recontribution strategy is where if I was to pass away and my superannuation is to go to my adult children, and there would be a 17% tax on the taxable component of my fund. So the taxable component is made up of those concessional contributions, the employer contributions that we've put in over time, where we've gained a tax advantage, or it's been our employer putting the money in. Any money that goes in non-concessional with pre-tax money, or where you've paid your tax at your marginal tax rate and then put it in as a non-concessional, then you don't, that forms part of the tax-free. But if my money's to go to my adult children who are not financially dependent on me, 17%. If it's, now I'm not trying to scare people, for those that see, for a couple, it goes to each other completely tax-free, no issues at all. But we're obviously doing the planning around reducing that taxable. So taking big lump sums out to put them back in using the non-concessional rules, the limits there, that negate some of these potential taxes. And always tell, the ideal strategy is that when you get to 93 and reasonable health, you say, geez, we've had a good run with this tax-free environment. It might be time to wind up the super fund at that time. Any questions on that one? If I mention death taxes, it makes people instantly cringe in their seats. All good?
In that situation, you're still relying, you say take it out, then put it back in. But you can't put it back in if your amount in the system is already $2 million or something.
Correct. If you're already over the total super balance, which is 1.9 this year and 2 mil, yeah. So if people have, if you smash through that, you take it out, you can't get it back in.
But basically, later in the superannuation, it's getting more restricted in that sort of situation. If you're up near those balances.
Correct. And what I do, Brendan, is it's a matter of just knowing what the liability is, and definitely not panicking when I'm sitting in front of a couple, because it goes tax-free to each other. But when someone's not there, that's when there's the liability becomes quite real. And that's become far more complex for our local farming community. It's about 80,000 people that are affected by these new taxes. I feel like I've got a whole hunk of them because there's so much farming land in our self-managed super funds that we look after, and land prices, like all asset prices Australia-wide, it's causing problems. Not problems that we can fix, of course. I'll just make a quick note on work test. There's no work test all the way up to age 60. Years ago, there used to be. Once you hit 65, you had to meet the work test, which is 40 hours over 30 a month, we'll call it 30 days, and you had to meet that before you can make a contribution. Once you get to age 67, if you're making a non-concessional contribution, you do not need to meet the work test. So the recontribution strategy can stretch all the way through to age 74. If you want to make a concessional contribution where you reduce your tax post 67, that's where you still need to meet the work test. It used to be a thing where people were being employed by their kids for a token month or token week so they could get money into superannuation. Now, who remembers the co-contributions? So this has been about since Howard and Costello years, and at times it was very generous. So for those that are a bit younger in the room, thank you for coming and being interested for one. But this is where if you earn under, this is this financial year, $45,400. If you earn less than that in this financial year, you put $1,000 of after-tax money, so money you've already paid your tax on, the government will give you $500 for free. That is a 50% return on your money. So pretty handy. It phases out at 60, and here's the new figures for next financial year. So put $1,000 in, the government will give you $500 if you're under the lower threshold. If you're over your total super balance is over the 1.9 or $2 million, then you're not eligible for it. because you can't make a non-concessional contribution. So, pro tip for grandparents. So, if you've got the 14 to 9 months grandchild that's working, and parents, not just grandparents, obviously instead of giving them more stuff they don't need that's going to go in the closet, most people have everything these days. Combine all their money, make a contribution to their superannuation fund, and make sure they do a tax return, and you are really setting them up tens of thousands of dollars in front by small actions. Most people don't need much more than a smartphone these days. So that's something that I started to do for my children when they were reasonably young, because they worked at my place, they worked at the office, and we've benefited from the co-contributions. And that, as I said, that will have a tens of thousands of dollars difference down the track. The spouse contributions. These, people haven't used this much at all. They're not common, they don't get spoken about. These are small wins, not big wins. But the spouse contribution allows people to put in up to $3,000 in their super if their spouse earns less than $37,000 per year. The spouse that puts the money in gets a tax offset of $540. That is an 18% return. Again, these are guaranteed returns. It's nothing to do with markets. It's saving tax. These are the simple wins that I encourage people to take up. It phases out once you get to 40 grand and above. Now, the downsizer. This is where I won't bore you with this one, that if you're over age 55, you've lived in a home for more than 10 years, you want to go from the big family home to the smaller home. And when you sell, you can individually both put in 300 grand into your superannuation funds each. There is no age limit on this. There is no work test. You can do it whenever. It's $300,000 each. You need to make sure you do it within 90 days of settlement. So you can have whatever amount you like in super, and you can do it when you're age 90. Again, haven't seen too many people use it yet. It's a bit like the spouse contributions. Now, even rarer again is superannuation splitting. So this is where 85% of concessional contributions go into, say, a husband's name, but the husband is 50 and the wife is 58. And the goal is to retire in 2 years. The money we put into the husband's name is there for 10 years. It doesn't work with retirement. So we can help reduce tax for the husband by making concessional contributions, and then we split 85% of those contributions. And the 85% is essentially the $1 that goes in, less 15% tax, can be split up to the wife, who's a bit older. And then they have access in 2 years in line with their retirement. Or we can be cheeky and start to split it down to the younger one to hide it from Centrelink and the assets test at some stage in the future when people are eligible for the age pension. So we can work the system to suit whatever outcome that we're after. So again, not used very much at all, but pretty powerful stuff, particularly when there's decent age gaps. So that's where we're using it significantly. I think I've covered off on that. Super fund considerations. Now, this is something we do in our business in May and June of each year. We send out an email to all our clients' accountants, say, hey guys, what is our minimum pension payments based on last year's tax return? And then we make sure that we have paid out the minimum, because you're better off to be 5 grand over than $1 under the minimum, because that's when you may not get your exempt status where you're paying zero tax. So that's one to check. Farming land, case by case, a lot of complexity out there that we're working through very closely with accountants at the moment. For Arvid and Flick from Melbourne and Sydney, like residential properties from Sydney's gone through the roof. Farming land locally's done that and some, and it's that's where a lot of the 80,000 or 0.5% of the population are over that 3 mil on an individual basis in their super funds. It's been farming land. Reviewing superannuation estate planning. Binding death nominations, make sure they're right and valid. So we saw one recently that, it was a lapsing one, 3 years, and it was in the fine print. So it's one, it'll wash through, no worries, but make sure you revise your binding death nominations to make sure that they're valid and the money goes to where you want it to go. And essentially, don't leave it up to the trustees, people you don't know. So if you're in a retail super fund, Australian Super, the trustees, if you don't have these documents signed, it'll be up to the trustees, people you don't know, to decide where your money goes. And life insurances, given my experience and age in the industry, a lot of my clients, my age and above, their insurances are becoming expensive. So reducing progressively to eventually cancel when life insurance is no longer needed, but it can hide within superannuation. So you're paying for it, but it's not hurting your cash flow, so you don't notice it as much. So one to be mindful of. And the last one, I think, is transition to retirement. This is when people get to age 60 and are still working, you can access your superannuation. Why would we do that? We may want, say if you love your job, still working, but you've still got debt, you might kick off a transition to retirement, take up to 10% of your super balance each year to pay down your debt. Or if you've got no debt, but you haven't got the cash flow to maximise your concessional contributions of 30 grand per year, you kick off a retirement pension, the transition to retirement, and take out the cash flow you need to make sure you get the maximum tax advantage each year. And once you hit 65, working or not, you've got full access. So things to consider for next financial year, for those that are employed, an employee of a company, can be your own company, that the super contribution goes from 11.5 that your employee needs to make each year goes to 12%. So you might need to adjust your salary sacrifice. Next year, the 30 grand doesn't change. So it's 30 grand this year and next year. So no change there at all. And make sure that if you have made a personal contribution that you want to claim, that you fill out the intent to claim forms. Any questions? Easy done.
Why does it take so long for you to send out the intent to claim form?
We've got a lot of time to get them done. They need to be done before your tax return is lodged.
Yep.
So you send them off. So the theory is this, Brenda, that you can make a contribution today. It can get done any time prior to your lodgement of your tax return, but they need it. If it's self-managed super fund world, you're sort of talking to yourself in a way.
It's not our own paper, yeah.
But if it's, say, a retail or an industry fund, that the intent to claim form's got to go, and you need to get an acknowledgement from the fund before you lodge.
The important thing is to get your contribution in before Thursday.
The most important. Yep. Good. Thank you very much, everyone. Rachel.